been a good deal of discussion over the past couple of weeks about Australia's growth rate and whether the potential growth rate in Australia has declined. This was raised in a recent speech by RBA Governor Stevens just this week, talking about whether growth has actually slowed. As we see here on the chart here, the blue line shows the 10-year moving average of annual growth rates, and so in the past 10 years growth has averaged around about 2.75%. This come down from the 3 to 4% levels achieved during the mining boom early 2002 to about 2008. Prior to that, the growth rate did tend to average around about 3.25% over rolling 10-year periods. So 3.25% has been probably a longer term average. We are currently sitting at 2.75, which is the lowest we've seen really since the mid 1980s, when it was much lower, as you can see there. So what makes up this trend rate of growth or potential growth rates? Well, two of the key drivers, of course, will be population growth, or probably more specifically working age population growth, but we're using population growth here. So you're going to look at the same metric of annual growth, rolling 10-year averages, and that's the red bars that are presented here. So over the past 10 years, annual growth has averaged around about 1.5%, so population growth has been quite strong, so that should be actually pushing up the potential growth rates. And of course, during the 2000 period, 2000 to 2007, population growth was towards the lower end on those rolling 10 years at around about 1.2. Yet we saw GDP averaging numbers, as I said, over 3.5%. So the main driver there, obviously we had the mining boom, which was adding to growth over that period. But if we look at productivity, or one measure of productivity, which we'll just get up here now, stack that on top, and you can see there that so that's on top of the population growth. So, and we only have the data going back to 1980 for this particular series, but you can see that GDP per hour worked during the 2000 to 2008 period was very strong and helped push the overall GDP numbers up. More recently, I'll just take out the population growth. Now we're just looking at GDP per hour worked, rolling 10-year annual numbers. So very strong productivity growth during that period, and has since weakened back to around about 1.25% over the past 10 years. So just adding back population growth once again. So if we combine those two, if they are the two key drivers of trend or potential growth rates, then what they're suggesting at the moment, 1.25 plus 1.5, is growth somewhere around about 2.75% would be a potential growth rate in this current environment, given recent population growth and given recent productivity trends. Of course, understanding what your long-term growth assumptions is very important when it comes to, in the case of equity markets, the earnings growth assumptions. It'll be a key driver of that. It'll of course be very important for the government in setting its fiscal or budgetary revenue projections. Within monetary policy, it will help determine what the appropriate setting for monetary policy will be, i.e. if the potential growth rate is a lot lower, then perhaps it might explain why the unemployment rate is no longer rising despite growth being only 2.5%. So it is a key consideration for all these factors and all these decisions. One other area, of course, where it is very important is determining the level of bond yields. So if we have a look at a chart, there's the 10-year bond going back to the mid-1970s. Of course, the bond yield currently around about 3%. So we're looking at this on a quarterly basis. If we were to just introduce a measure of GDP growth, we'll use nominal GDP, which is probably more relevant when it comes to obviously to nominal interest rates. And we use once again that 10-year moving average. We can see that the relationship here, just modeling that against the bond yield, has fitted that fairly well over the longer period, the pink line being the fitted line, although in recent times you're seeing quite a divergence where we had quite strong nominal GDP growth during the mining boom and towards the end of that, and only now is nominal GDP growth starting to come off. The bond market is in some sense pricing in lower nominal GDP growth. And indeed, I think in the last couple of years, we're seeing numbers for nominal GDP growth more like 2 to 3% than the 4 to 5% that this 10-year average shows. So it is a key driver of the level of bond yields. Obviously, other factors will help determine that. Cash rates, if we add that in there, that's the impact of cash rates. And then, of course, for Australia, one key driver is also the 10-year bond in the US, as we can see there. So looking at those factors at the moment, as I said, nominal GDP growth or trend nominal GDP growth is a key consideration in setting the appropriate level of bond yields. Thank you.